Hey guys, welcome back. In today's video, we are talking about how theaters are going up, how to beat manipulation, the zero liquidity, and many more in this video. First, we take a look at this. What's good for the industry is still bad for AMC, apparently. These fools want you to believe that the market is forward-looking. So if you take a look at the comparison for AMC, IMAX, and Cinemark, of course, all in the same industry, once again, we're seeing AMC red, whereas IMAX and Cinemark is, of course, going up. Now, recently, we've seen IMAX, we've seen Cinemark, and we've seen what their earnings is like. AMC is yet to come. So we can obviously understand why, these theaters showing good earnings, why they see the price go up. But typically, when you do see the other competitors in the market to go up because they have good earnings, you would expect AMC, the one who's bigger than them, all of them, the one who will, of course, if everyone else is profiting, so will AMC, you will see AMC actually going up as well. But in this case, we are not. And there's a big reason. You can see what they said, theaters are killing it, and the biggest one of all, with its own line of popcorn and candy, is trading near all-time lows. So firstly, like I said, there is a reason for why we're seeing IMAX and Cinemark going up, because they've shown that they have good earnings. But what we should expect from this is that if IMAX and Cinemark were to have good earnings, AMC would also have good earnings as well. And typically, this would encourage more investors, or at the very least, to not make investors actually sell off AMC shares, especially when you see the competitors going up 8.65% in one particular day, especially understanding that AMC is bigger than these companies. AMC has, like what we talked about here, own line of popcorn, candy, film distribution, investor base, and of course many more as well. On top of that, AMC theaters accounts for 50% of all IMAX screens and 100% of Dolby Cinema screen domestically. Like we talked about, AMC has a lot of exposure in the overall industry. And what we talked about in the past before is that even with a lower box office, we are still able to make more money now. And with various different ways, like again, we're going through what we talked about here, popcorn and candy, beverages, and many, many more. And so these are what we talked about in terms of understanding why they're trying to press the price down. This is obviously the sentimental, the psychological place that they want to push off to other people. When you see that if you want to invest in the theater industry and you're seeing IMAX going up and you're seeing Cinemark go down and you're seeing AMC go down, you're very likely to invest in the ones that are going up without doing any due diligence. Now, when you do your due diligence and you understand exactly everything that's going on, obviously it will change your perspective. But they want to attract the people who just want to quickly invest without doing the research. And of course, you would want to invest in IMAX, in Cinemark, because you're seeing the price go down whilst AMC is going, you're seeing the price going up whilst the price of AMC is going down, and you'll think that AMC is a bad company, when that's clearly not the case. And like I said, this is why you always got to do your own due diligence. Is why you always got to do your research. Now, there's a big reason for why we say this. It's because to overwhelm stock manipulation like naked shorting and spoofing, you need catalysts that enticed huge numbers of retail investors and traders to buy in. Like launching beer and wine or new forms of entertainment or launching a new social media platform, you got to execute. And so this is what we've seen in terms of understanding why they want to push AMC down. Because they understand that the only reason they're able to push AMC down is because of the naked shorting, is because of the spoofing. Now, in order to overwhelm this, in order to overwhelm the algorithms that we talked about in the past, you obviously need to have things that will encourage investors. So we've seen it, whether it's from the technicals, from the chart, whether it's from the fundamentals, so just looking at the earnings, or whether it's psychological. Now, from the charts, from the technicals, we see people buying it all the time. From the fundamentals, when AMC releases new earnings, it will of course attract investors for the ones that do research. But the psychological, and I think that is the most important factor, the psychological factor, and that's what they're trying to get people. Because you can see here, like I said, this is a very, very simple screenshot, but I think it conveys a lot of messages. Because if you don't do your research and you want to invest in this industry, I think you would pick something that is just going up instead of going down when you don't understand everything that's behind it. We know what's behind this. We know that the reason AMC going down isn't because it's a bad company, isn't because it doesn't have a business. We know that that's all not true. We know how AMC's business is operating. We know how AMC is a good company. But the reason why it's going down is because it's being manipulated. But for the ones that are new to this industry, for the ones that are just trying to invest into the theater industry and don't know about everything, the ins and outs, They won't realize this, and that's the psychological battle, and that's why shorts continuously try to push the price down, because they want to entice people to not buy AMC and buy other stocks instead. And that's why, again, we always share our due diligence. Is why we do this, to make sure everyone understands what's happening in the market right now, what's happening with all these manipulation tactics that they are of course implementing on us. And there's more reason for why they're desperately wanting to do this, because if you see here, reverse repo liquidity got crushed down to $155 billion today, minus 34% over the 60-day average. The US Treasury bonds issuance is draining the cash from money market, mutual fund as bonds are going no bid more often. Other countries are hesitant to buy US bonds. It will negatively impact our economy in a huge way in the coming months. So like we talked about, reverse repo is going down. So this is something that we've always said on the channel, that the reverse repo is going down. It fluctuates going up and down, but the overall is that it will go down. And just like we talked about here, 60-day average is down 34%. And that the long term is the important factor. We don't care about it going from day to day. We care about it in terms of a 60-day, 180-day, a 1-year average. And in all of that, it's all negative. It's all going down. So this is highlighting multiple things. Firstly, the illiquidity issues in the market. We talked about how reverse repo was obviously easy access to money. And so with the reverse repo going down, we're seeing a less accessible money for these institutions. Now, the illiquidity is obviously with the treasuries. Now, bear in mind that there are a lot of assets invested in the treasuries, and that itself is also what they use as collaterals. So we're also going to be seeing that go down as well. And so overall, what we're seeing right now is kind of the diminishing capital from these hedge funds, from these institutions, from these banks, which all correlates to AMC, and is why they want to suppress it as much as possible, because they want to make sure that they can push the price of AMC, that price down, whilst they still have the ability to, whilst they still have the money. When the reverse repo goes to zero, when the market crashes, when everything goes into flames, they won't have that power. And that's when every mistake that they've created will come back to bite them. They're in a race for time. They obviously want to push AMC down to make sure every retail investor sell. And so they are racing from whether it's going to be us selling first, or they are going to be running out of money first. And that's the battle that we are, of course, fighting here. We talked about how every single day it costs them money to finance the shorts, it costs them money to create more synthetics, it costs them more money to do all these FTDs, options, etc., etc. All of these things are costing money. It doesn't cost us a single cent on holding our shares every single day, and that's why we have the advantage over them. As always, none of this is ever financial advice, so do take care to kind of sell. Make sure to do your own due diligence and research. Like I said, the next thing we're looking at is US banks sitting on $750 billion in losses on real estate debt related securities. Which sectors are most exposed? So again, just what we talked about here, the illiquidity issue, the problems with the treasury bond issuance. Now we have the real estate and $750 billion in losses on real estate debt. Like we talked about, the banks also have trillions in derivative positions that they are losing hundreds of billions of dollars in. So you can see how all of these things are stacking up. And like I said, these are all relating, because you've got to understand that these banks are the very firms that are lending out to the short sellers who are using that money to short AMC. And so if we see that the main source of money, aka these banks, are all losing out money, are less likely to loan, then you can see how short sellers will have a harder chance to get money to suppress AMC. Another thing, breaking news, 30-year mortgage rates are not slowing down and are now at 7.37%, which is the highest level since early July. When these rates hits 10%, that's when the bubble pops. The bubble will realize that 2008 was nothing in comparison to this time. So this is obviously relating to what we talked about here, but again, it's just another perspective of what's happening in the market. Like I said, it isn't just one or two things that is showing us signs of the problems that are coming, of the market crash that's about to happen. It's multiple different factors. And so this is just one of them. And this is why it's worrying for the overall economy, but it allows us to understand that the shorts are indeed running out of time. Another thing is, so the SEC admits to knowingly allowing unbacked, unallocated, approved non-securities to be traded and used to manipulate NYSE traded stocks for years. Gary Gensler, thank you for ignoring your mandate, millions of investors affected. And so, this is what we talked about in the past. past. Now, again, this is just kind of answering back to the people who says that when we talked about the cryptos, when we talked about all of these things, people claim that it was conspiracy. We had people talking about how naked shorting wasn't real, but yet you're seeing how government like South Korea, like China, who are fighting against naked shorting. You're seeing people saying how these tokens weren't actually useful, that they were fake, that they were just made up, but yet you're seeing the SEC admitting to knowing, allowing these things to happen. And so all of these things that were once quoted as quote unquote conspiracies are now becoming true. And this is what we're doing. This is what we are exposing, and it's why we said make sure you share all your due diligence out. Feel free to share this video, feel free to share any tweet, make sure everyone understands what's happening in the market. And guys, thanks for watching. I'll catch you guys next time.